Well, it's hard to go past the moves we're seeing in Chinese and Hong Kong equities at the moment. Whether you're looking at the Hang Seng, the H shares or the CN50, the moves are pretty much parabolic. We're seeing some absolutely incredible moves here. But is it too hot? Should we be chasing it, or are we like to see some mean reversion playing through? Geopolitics is very much front and centre at the moment, but despite some big volatility in the crude price and gasoline price, we're yet to see this really spill over in kind of any broad malaise in financial markets. We are watching the US dollar as we go into payrolls, and we look at the playbook around that and where the balance of risks in rates and also the US dollar goes, depending on the outcome, of course. And we're seeing yen sellers in the mix as the new Prime Minister talks down the idea of future rate hikes playing through. There's a lot going on in financial markets. We look at what's hot, what's not, and where we like the balance of flows at the moment. This is the trade-off. Well, hi there, I'm Chris Weston from Pepperstone, and I'm going to be joined in 2 seconds from Blake Morrow from Forex Analytics, and we will be discussing the various macro thematics playing through, the sentiment on the trading floors at the moment, what we're seeing in terms of flows and directional risk, the setups, the price action that's really coming across our radar at the moment. So Blake Morrow, please come into the programme. I was away last week. I was sunning myself in Bright in the Victorian rural districts. Very, very beautiful part of the world. I think in that time I was just looking down at my my phone, getting push notifications about Chinese markets absolutely going for it, and various other factors. So there's plenty that I seem to have missed out in that regarding. But yeah, how have you been?
Well, I missed you, Chris. I missed you last week, and I think the whole staff here at the Trade-Off, we all missed you. So it's nice to have you back, and I'm glad you had a nice holiday. But I'll be the first one to tell you, you kind of missed a lot. The markets were moving, and man, we've got a lot of volatility. Even though we're still perched up at all-time highs, it seems like we're getting a lot of volatility while we're up at these all-time highs. That's for sure. Good
stuff. Well, I closed all my positions, got out onto the trekking, into the treks, and did some decent walks, got the mind completely clear and refocused. So now back with a vengeance. So I've had a couple of days now to look at what's been going on and look at the price action, where the risks are in the playbook. So I think it's a good time to tackle them. Let's go straight into the market review. Right. I brought up China because, the stimulus that we saw throughout last week in different clips was probably the biggest stimulus that we've seen from China for a decade, and it obviously encountered on a very significant monetary easing, but also some fiscal response as well. There's a lot of liquidity measures which have been pushed into the stock market as well. Half a billion dollars or $500 billion of renminbi of swaps for brokers to go into equities. Also, companies to come and buy back their equity by getting credit from the bank for 1.75%. So there's been a lot of liquidity measures, as well as the cuts to the deposit rates and lending prime rates and various reserve ratio requirements and various factors as well. So a significant easing. But what we've seen in Chinese markets is incredible. The Hang Seng, I think, in the last 13 days is up 32%, which is 6 or 7 standard deviation moves. I don't think we've seen a rate of change, 13-day rate of change since 1977 on the Hang Seng. So, for a market to move by 32% or so in that sort of space of time, a large cap market is absolutely incredible. But if I look at the internals on the market now, of course they are overshot. Yeah, it's very, very hot. Very hot. The flows that we've seen into the ETFs, into the managed accounts, has been absolutely staggering. Question for me, or for you, Blake, is after these parabolic moves, is this too hot to chase now? Given how significant the monetary injections have been and the policy response, is it too hot to chase these markets here? Do we wait for a pullback? Is it too hot to short? How do you go for it here?
Well, it wasn't too hot on the first 10% rally on day one, but day three, because day two I think we consolidated, but then day three and day four, when you're up another 20%, I couldn't chase it up here. Not seeing the economic data and seeing what the stimulus is going to do. I mean, as you mentioned, it is such a massive stimulus measure, and it was really China throwing the kitchen sink at the Chinese economy. whether that turns the corner internally is something else, because I don't think China is all domestic growth. I don't know if there's much domestic growth. I think China's going to rely a lot on what happens in the rest of the world. Does what they all the measures they've made, maybe it does move money supply a little bit, but does it take pressure off of some of the declines on the residential real estate properties? I don't know, and I don't know if it's going to spur domestic spending. And is it going to be enough to offset, potentially a slowdown globally? So I wouldn't be chasing up here. That doesn't mean I wouldn't buy a pullback if there was a significant pullback. I think there's a lot of nice technical
I think that's the way. Yeah. I like buying pullbacks. I mean, I think this is a big deal for China. I think it's difficult to say this is going to go and stoke big demand for property. I mean, the down payments that they've cut for first and second home buyers, from 20 to 15% will do good things. But is it really going to change a massive perception of people's understanding of where asset prices or how property prices are going to go? I'm not sure that's going to be the case. What I think it will do, though, is I think it will change an economy that is exporting deflation to a much more neutral stance. We've actually started seeing upgrades for next year's GDP from various research houses as well. So that's a positive. I think it does change the growth dynamics and the inflationary dynamics, but I don't think it's going to set them off in a big capacity. The liquidity is very good for equities, as we've seen. I mean, 30%. I wouldn't be buying here. I'd be waiting for a little bit of heat to come out and then following in there.
Well, there's a lot of underinvestment in China. So I think this is a great backstop. It allows for traders and investors to kind of know where their downside risk is now moving forward. But from the risk reward, where you're at right now versus where you're at just a few days ago is completely skewed. So chasing it up here doesn't make any sense to me. Hey, what does make sense to me, and I think it's going to be a fairly binary type of event, is the non-farm payroll on Friday. So I wanted to ask Chris, because the Fed is squarely focused on the labor market, and it seems like there's a lot of traders still betting against the U.S. and the U.S. economy, thinking that any day now we're going to get a weaker than expected jobs report. How are you going to play the NFP? Because I kind of have a couple of setups that I'm looking at, but I'd like to hear from you first, and then I'll give my response after that.
I would be reducing risk into the payrolls number. I'll be looking to reduce dollar exposures going into that, because the risks for me are two-way, and I think I'd look to re-establish positions once I know the facts. I know you obviously miss out an initial move, but I think the outcome could be very telling. I mean, I think from an equity perspective, I think 180,000 jobs would be a nice number to have. That, especially if the unemployment rate stayed at 4.2%, I think that would be the Goldilocks scenario, because that keeps the rate cuts in play, but the economy is still okay. I think that's a Goldilocks scenario. I think the Nasdaq finds a strong rally on that. Risk goes hard on that. The dollar probably won't do a huge amount. I think if you were to see sub 100,000, your line in the sand. There are a few banks calling for sub 100,000, cities calling for 70, for example. I think sub 100,000, I think that really just puts a 50 basis points firmly on the table, and I think that would be the default solution. Front end yields will go down. You're going to get a bull steepening of the curve. The dollar's going to go down against high various plays, certainly against the Swissy and maybe against the yen as well. But that would be the line, especially if it, and or we saw the unemployment rate was to tick up, rounded up to say 4.4%. I think, either situation, I think risk gets hit badly on that. I think equities go down because people question the soft landing thesis. So that's my playbook, Blake, and I'll talk to you a second. 150 to 180 on the payrolls number with an unemployment rate, bang, buy risk. I think in that situation, Goldilocks. Sub 100,000 or the unemployment rate ticks up to 4.4. Selling risk, selling equities. The hard landing thesis gets questioned or gets called into question there. So what are you doing there?
Well, I'm playing it about like you. Above 150, I think it's a solid number. I mean, obviously, we're going to be looking at the unemployment rate, especially if we're around the 4.2, 4.3% level. What I'm looking to do, though, is I'm looking to actually buy dollars against the euro. The euro looks like it's vulnerable. It looks like it's going to drop towards 110. Yeah, I think that it does. Now, the flip side is if the headline number is a little bit weaker, unemployment rate ticks up. You look at like, and we're going to talk about it here in a second, but some of these commodities are on fire. Whether you're talking about copper, whether you're talking about crude oil, whether you're talking about iron ore, gold, whatever you want to talk about, on a weak number, I think the Aussie really takes off again, and that's a pair I'll be watching, even the Kiwi as well. So that's how I plan on playing it. But obviously, as we get closer, the plan might alter just a little bit based on price action the next couple of days.
I want to just pull you up on that. I know I'm going to get abuse from the producer for going over the time, but this idea that if we do get a weak number, the dollar should in theory come under pressure, right? So you do get sub 100,000, unemployment rate 4.4%. That's bad for the dollar in theory. But if the equity market comes under pressure, credit spreads widen, and people sort of call that soft landing thesis into question, will the Aussie actually rally? Because the dollar goes down, but you also got that growth pro-cyclical sector there. So Aussie dollar against the US dollar, does it rally or does it fall with equities?
Well, I think you have to watch for the knee jerk, because it could be a knee jerk reaction. You get the initial dollar selling, Aussie spikes higher. Then at that moment, that's when my attention leaves FX, goes towards gold and equities and see what they're doing. Because ultimately, I think the Aussie would actually follow risk.
Yeah, I think so. Yeah. But you'd probably play that against the crosses, maybe so Aussie Swiss or something like that. But let's go into Japan, because it's an interesting one. What I don't like, there's a lot of things I don't like, but what I don't like, and what the broad market doesn't like, is when bank independence gets called into question. So you've got the new Prime Minister of Japan who's come in, and immediately he's come in and said, I don't want rate hikes to happen. And people who've been betting on rate hikes throughout this year, and certainly starting into more prevalent in 2025, that's been called into question. So the yen's been hit pretty hard. I don't mind. The central bank coming out and talking about rates, and Oeda and his vice deputy, but when the Prime Minister comes out and talks about rates, you've got big government being involved in policy and monetary policy, and we don't want to ever see that situation. We really don't, and I think that sort of that's muddied the waters a little bit. But the yen's been flogged on the back of that. Obviously, dollar yen's had a big move, but we've seen a massive move in the MEX. Now, the question I'm going to ask you is carry back? Are we using the yen as a fund carry, knowing that the volatility is still pretty elevated, knowing that the geopolitical risk could, headlines could derail markets pretty closely, or is this just purely people just taking out their rate hike bets and saying, done, let's move on to something else, and the yen's under pressure? How do you see this yen playing out on the back of the new calls there?
Well, let me just tell you, I'm going to be the first person to say I'm not Zero Hedge, and Zero Hedge does believe these all announced at the top of the mountaintops that the carry trade is back. Look, I'm on the your second scenario. I think that some of de-risking of yen longs has happened and is happening. But as I told you 2 weeks ago, Chris, and I was actually looking under a different scenario, but I was expecting weaker yen, dollar yen towards 148 to 150. Then I'm going to sell the heck out of it. And I still am actually planning to do that. I'm still looking for a little bit more of a squeeze, a little bit of shoring up of positions. But we get to 148, 145, or excuse me, 148 to 150. I am looking to actually sell dollar yen. I'm going to be looking to buy yen because I think it's going to be a trade that's going to play well into some of these geopolitical risks that are surrounding the markets. How are you going to be playing it?
Well, a couple of weeks ago, we were talking about that dollar yen, and great call by you. I was waiting for a close back below the 5-day exponential to get short, and that never happened. So, it was a good filter for me to keep me out of the trade until the market turned. But I feel like there's far more juice in the yen shorts right now. I don't think this is necessarily a big carry position coming in, because for the carry trade to really work, you do need lower cross asset volatility, and it's the VIX is still at 19%. FX volatility is at 8.5% or so, and you've still got rates volatility reasonably high as well. So we need that to pull back for people to go into carry, and people probably want to see a better move into tech and momentum to use that yen to buy into equities as well, and we're not seeing that. So I'm not fully on board. I think there's a lot of people out there who'd been long Japanese yen and obviously hoping that we were going to see a more aggressive rate hiking cycle from the Bank of Japan than what was priced, and they've been very frustrated by the involvement of the PM in monetary affairs. So I think that's just a repositioning. But I do think there's a little bit more upside in dollar yen, and obviously that's going to be conditional on the payrolls number. A little bit more downside in the Japanese yen in the short term before I flip those. So that's where my bias sits at the moment.
All right. Well, I wanted to take this very last topic to talk a little bit about these port closures and talk about what's happening here in the U.S. And it's not something that's obviously going to affect you, but living here in the United States, it is something that's affecting us, especially those of us that are traveling to Costco just to get toilet paper. All of a sudden, we have no toilet paper in the United States, as everybody's hoarding toilet paper.
Feels very COVID-y.
It's this post-pandemic paranoia that we're going to run out of toilet paper. They don't understand. If you just Google it, toilet paper comes from Arkansas, Illinois, all above, in the northern United States. It doesn't go through the ports. So stop buying toilet paper and stop being dramatic.
Mate, when I get home tonight, I've got a new fact to tell the wife about where toilet paper comes from in America.
But the fact of the matter is, there are some strikes that are happening in some of the East Coast ports, and it could cause some disruptions here in the U.S. And his name is, I believe, Mr. Daggert, forget what his first name is, of the ILA, and he the Port Authority there, and he's the president, and he's a shady character as it is. I'm not going to say he's playing politics, but this is, the timing's a little suspect, and we'll see. But the fact of the matter is, it could create some inflationary pressures here in the U.S., especially if it becomes prolonged. And so that's something that if you are a dollar bear and you start thinking about some of these events that are happening here in the U.S. and think about how the market's really priced, rate cuts into 2025, that could really come under question, especially if these ports stay closed throughout the election season.
I'm going to jump in because you raised a point about supply chains and the impact that could have on price pressures, and that is in theory a dollar positive. How do we look at it the other side though, Blake? I mean, if we're going to see the port closures for a period of time, that's going to have an impact. Potentially, it could have a negative impact on the October non-farm payrolls number, which comes out on the 1st of November, right? Yes. So you're going to see, Bloomberg was saying there could be 80,000 jobs that come out of the payrolls report. So then you've got a low payrolls number in November, which could really influence the FOMC meeting. But the longer this goes on for, it's going to have a negative impact on the Q4 GDP calculation. So you've got price pressures from the supply chains negated or offset by a negative role in the payrolls and a negative GDP print. So what's the net effect of this on the dollar?
Well, I still think the net effect is a dollar positive because, all the economists would look at the jobs data and say, okay, well, we got to shave 80,000 or 70,000 off of our headline estimations, but everybody's going to make that downside.
It's going to be a one-off, isn't it? It's going to be a one-off
estimate.
Yeah,
it will be a one-off. So I think really it becomes more of a dollar positive the longer this happens, and it's going to create some ruckus. And like I said, I'm skeptical. It might be a bit of a political ploy, kind of a monkey wrench thrown into the political machine, as we head into the month of October. So just keep a heads up for those of you that are trading around. It's
an interesting dynamic, but we'll have to see. I mean, I think a lot of businesses did move their supply chains out of that, but not everyone did in that session. But there you go, an interesting dynamic for the market to contend with. Anyway, let's go into the technical side of things. Let's go to That's a Setup. All right, we talked. You mentioned just a minute ago there, Blake, about believing that there's a possibility of further downside in the euro dollar. So let's bring up euro dollar because I've got that one to hand. It's something that I've been discussing with a few clients about this morning. Obviously, there has been some euro issues at hand. We've swung now to a full rate cut being priced in for the next October meeting from the ECB. That wasn't expected. They were expected to hold that one out. We've seen the French budgets coming out. They've lowered that, and effectively that means a little bit more austerity coming through as in their budgets. And again, all of these factors have weighed with lower inflation coming through in Europe, Germany, France, and on a headline basis, people ratcheting up their expectations of a cut now in October. We're pricing 55 basis points in Europe by the end of the year. So essentially two 25 basis point cuts, a slight more that we could get at 50. And we've seen a bit of US dollar flows playing through, and I think partly led by a slight rebound in dollar CNH as well. But we've come up to that 50-day moving average on the technical side of things. So it's been a trend filter. Can we break through that? Then we get the swing low, the range low at 110. That is a big level there. Onto that. So a break of the 50-day accelerates the selling down into the bottom end of the range. That's the level that everyone's going to have on their radar. 110 or 110.02 I think is the exact number there. But that swing low that we saw from the 11th September, it gets there, breaks there. Obviously, from a technical perspective, that would have real significance. I expect a few scalpers to come and buy, support that level and to pick up a few pips around there. But that's the range low, big levels to look at. This has to be on the radar, surely.
It sure does. And what I have on the radar, Chris, is I have the dollar Swiss, which is obviously the inverse of the euro dollar. And we have a very tight range between 84 cents and 85.50. And we're wound up really tight. We're past the Swiss National Bank. I think this is more of a yield move. And if you're watching the dollar yen popping higher, you're watching, the 10-year slumping a little bit, the notes, 10-year notes. Yields are starting to look a little perky. This could take us through, especially if you have a strong, report. This could take us through that 85.50 level. Next thing you know, you're squeezing past the 50 DMA, which would be the opposite of what you were looking at on the euro. It could take us all the way up towards 88 cents. I mean, it is entirely possible. The flip side is, though, if the economic data starts to weaken, this support right here at 84 cents is very, very strong. And a break below that, you've got horizontal support that goes back at the very end of 2023 in December, and that comes in at around 83.30. Below that, there's a lot of open air. Trust me, there's a lot of open air below that 83.20 level. So I think a big breakout is looming. I have no position right now, but this is something as a setup, you got to have it on your radar.
I agree. I think this is a brilliant setup because, that's like a little bit of a cold spring. The longer this goes on for, the more powerful it's going to be. And you've got the events. We know what the events are going to be. But I think when the market shows its hand, I think this could set off a trend and a trend that doesn't last one day. I think it could go on for a while. So definitely one to keep on the radar there. Let's have a look at the crude move that we've been seeing, because obviously, when we're talking about geopolitics, this is front and centre at the moment now. If you have a look at the chart, we got back into the former resistance level just above $72 on WTI. A few sellers in the mix overnight. We did see the Department of Energy coming out of their weekly inventory numbers, just over $3 million barrel build, bit of a lower gasoline demand as well. I think that sort of took some sellers out there, but obviously everyone's watching what's happening between the Israel response now to the ballistic missile attack that we've been recently seeing. What is going to be the response from Israel coming through, and of course that is keeping us very much on edge. And we've seen President Biden reports this morning that President Biden is looking to do some sort of mediation here and sort of talk to Israel to keep them away from any kind of nuclear sites, which hopefully that's obviously going to be the case. But the market is concerned that we could see an energy supply shock. Obviously, humanitarian side of things is another factor, but from a geopolitical perspective, we are worried. Will this lead to an energy shock? Will there be a response from Iran? Will America have a greater involvement in this? So I think you've got to keep an eye on Brent. I think you've got to keep an eye on gasoline. I think you've got to keep an eye on WTI because they are going to be reacting to the headlines. I think we get a break above that horizontal supply zone that we've been seeing. It could really kick, and you get the downtrend in place, the 50-day moving average in place, and that could really kick. I'm not going to claim to be a geopolitical expert, a military strategist in any capacity. The price action will tell me everything that I need to know and where the balance of risks are going for. But I think, you've got that big resistance level coming through. If it breaks through there, I think, this could go on a bit of a run. So obviously that's going to be conditional on what we've been seeing, not just on the demand side, but also, perceptions around geopolitical risks and obviously the impact of potential supply.
That was the exact messaging I gave to the Forex analytics traders as well. I'm like, we start breaking above that resistance, then that is the market telling us that the situation in the Middle East is starting to tick up a little bit as far as from a risk perspective. So anyway, great chart,
I think it's interesting because look, these things typically resolve in a market friendly fashion. We've seen lots of this headline. This feels as I say, my opinion counts for nothing in this really, but it does feel like that this is something that I think that people are watching a little bit more intently than other episodes or other issues.
I think so, because this has been long. It's been dragging on for a long time, and it seems like this tit for tat type of action in the Middle East from Israel and Iran. We don't want it to continue to go tit for tat to tit to tat, and who knows? Then it goes into all caps, and who knows what happens after that. So let's hope for the best, Chris. All right, and speaking of which, maybe a great risk proxy would be my last setup, which would be the dollar MEX. It might be taco time now. I do have some Mexican peso exposure. I actually bought it today at that channel support at the 50 DMA, basically right where we're at right now. Because from a risk reward standpoint, this is a very, very clean setup. Now, if you guys are in the camp that the market's already priced in everything that's going to happen with the new Mexican government, which was inaugurated, and things are going to get better in the Middle East. And let's say you're a glass half full type of person, you start breaking below the channel support around 1925 or so, below that 50 DMA, you're going to have a nice downside move. I mean, that's where you're going to find my stops. And then below that, it's going to open up some downside. But the flip side to that is if this ascending channel stays in play. And by the way, this is an old chart that we used that ABCD equal leg pattern months ago. But if you start getting above 20, you'll see that we're clearing the long-term 38% retracement. I have a fear if we get much above 20.15, we're going to be trading closer to 21 in fairly short order. So that would be another risk proxy, Chris. If that broke out, that's kind of like crude breaking out to the upside. It's telling us that the market is very unconfident about the situation that's happening in the Middle East. So
yeah, okay, cool. All right, well, let's go to play of the day. I'm going to keep it on the Mexican vibe because I think there's further juice in the upside in dollar MEX. I'm not going to opine too much on what's happening in the political situation in Mexico, but I just like the price action from what I've been seeing here. You've seen the market put in the base. That base took a sort of 10 days to sort of materialize. We sort of had some energy to try to the upside, and then you can see that we've just really broken out quite powerfully here. We saw a 3% move on the day. The LATAM sort of complex did very nicely. We saw another 3% move in dollar in the Colombian peso against the yen, and the yen now. I think I don't think we're going to see a sustained bear trend that we've been seeing in dollar yen and the yen pairs more broadly. I don't think we're in that world where you're just going to see a significant long-term trend. But I do feel like there's more juice in this trade. I've bought the breakout here. I think very, very small size. I think if we get a break above that 50-day moving average, I'm going to look to add to that trade. You can clearly see where your risk is. But I bought the breakout. I like the fact that the market closed near the highs. I did it in small size, and I'll be looking to add to that trade. If it starts to show some trending material. So I think lower volatility in markets would be very, very handy for this trade indeed. If the oil price kicked a little bit higher, not because of geopolitical issues, but because of better data, better demand, a good non-farm payrolls number. I think that this trade works. But starting in small size, if it works, and I hope that real kicks as a momentum trade.
Well, from a title point of view, Chris, one a peso the action, you win. You win. Thanks, you win.
I've been working on that one for weeks.
Yeah, I love it. All right. My play of the day is something I do not have an exposure in, but the Euro Aussie is set up in my favorite reversal patterns, which is a descending wedge, or I love an ascending wedge. Descending wedge is when the that trend line, that upper trend line is much steeper than the lower trend line, and we're actually moving into the apex of the wedge right into key support. So while we're above 160, I think the risk is we start actually ticking higher in the Euro Aussie. Like I said, I don't have any exposure yet, but probably about an hour or two after the show is in editing, I'm assuming I'm going to have a long position because I think the risk reward is set up really nice. It's also a hedge against risk. If you're long Euro Aussie, typically that means that it's a risk off type of trade. I know we're at all-time highs in equities. I understand that. But we know where our risk is in the Euro Aussie. And if we start to see, some of these risk events play through, whether it's the port closure, whether it's tensions continue to rise in the Middle East, I think the Euro Aussie is one that's going to play right back to the upside and back towards that 50 DMA. So I think that's going to be my play of the day, long Euro Aussie. I'm not long yet, but I probably will be between now and the next time I see you next week.
Yeah, cool. Well, I think the Aussie is an interesting one. I think that the Aussie Kiwi is a better is a good long, and maybe so I'd be flipping out of the euro and being short, being long euro against the Kiwi dollar, because I think the Kiwis, I think the RBNZ cut by 50 basis points next week. I think that's one largely discounted now, but I think that's looking pretty weak and pretty vulnerable now. So I'd be flipping out. I know the technicals are the technicals. It doesn't really matter what market you're looking at there, but I think the Kiwi's just looking pretty ugly at the moment. I like Aussie Kiwi longs at the moment. Yeah. Anyway, there's a lot more we could discuss. Obviously, we've got US earnings coming up in the mix soon, and that's something that we'll need to be focused on. We've just seen the vice president debate coming through, and obviously now we're going to be very much more focused on election odds and how that impacts markets and the trades around that as well. So there's a lot going on, obviously geopolitics, earnings, the whole works coming through. But in the short term now, it's about payrolls. Anyway, Blake Morrow, thank you very much. And for everyone at home, thank you for joining us. And if you want to click the like button, we'd really appreciate that. If you want to subscribe, tell your friends and family around the show, we'd obviously appreciate that one. And see you back next week for more of The Trade-Off.